Today we are breaking down one of the most spectacular corporate flameouts of the last decade. We're talking about a company that went from being a cultural icon to a total cautionary tale, incinerating nearly $50 billion in shareholder value along the way. This is the story of Peloton. 97%. Just let that number sink in for a second. That is how much value Peloton stock lost from its absolute peak. And here's the crazy part. This wasn't some overnight crash. No, this was a slow, agonizing bleed out of wealth, of belief, and of a story that, for a moment there, seemed completely unstoppable.
I mean, just take a look at this chart. Back in January 2021, Peloton was a $50 billion behemoth with its stock trading at $167 a share. Fast forward a couple of years, and it's barely holding on at around $4. So how does something like that even happen? Well, it wasn't one single event. It was this slow unwinding of a bunch of assumptions that almost everyone got wrong.
To really get how it all fell apart, we've got to go back and understand the promise, right? The story that got everyone so incredibly excited in the first place.
Okay, so Peloton's whole pitch was what they called the Netflix of fitness. And you know what? It was brilliant. Here's how it worked. First, they'd sell you this very expensive, high-margin piece of hardware, a bike for over $2,000. Then, and this is the key part, they lock you into a $44 a month subscription for all the classes. It's kind of the holy grail, a big chunk of profit right up front, followed by that sweet, sticky, recurring revenue.
But here's the thing. At the very beginning, the market was not buying it. Not at all. At its IPO back in 2019, the stock was just $29 a share. The common question you'd hear on Wall Street was, seriously? Who is going to pay $2,000 for an exercise bike? It just seemed like this super niche luxury product. Definitely not the next big thing.
And then something happened. An event that nobody, and I mean nobody, could have ever predicted. It was this unprecedented catalyst that took all that skepticism and just flipped it into pure euphoria.
You have to understand, the pandemic didn't magically create new demand for fitness. What it did was it displaced it. Think about it. Every single gym on the planet is forced to close. You've got millions of people stuck at home, desperate for a way to work out. All of a sudden, Peloton goes from being a luxury to being pretty much the only option.
And the growth was just insane. Revenue completely exploded, up 172% year over year in one quarter, then 232% in the next. The company literally could not make bikes fast enough. The wait time stretched to 16 weeks. People were paying full price and were actually happy to wait 4 months to get their bike. It was wild.
Now, this is the point where Wall Street completely bought into what's called a secular growth narrative. That's just a fancy way of saying they thought this was the new normal. The valuation skyrockets from $8 billion at the IPO all the way to $50 billion. The consensus thinking was, this isn't a blip. The pandemic has fundamentally changed how we all think about fitness. Why would anyone ever go back to a gym?
But here's the thing about a powerful story. It can only carry a stock so far. At some point, reality has to catch up. And for Peloton, this is exactly where that beautiful story began to completely unravel.
So, back in the summer of 2020, management saw those crazy wait times and made a fateful decision. They were going to ramp up production massively. We're talking hundreds of millions for new factories. But then came November 2020, the vaccine announcements. Suddenly, the world had a path to reopening, and by early 2021, demand started to normalize. Peloton had made a colossal bet that a temporary, once-in-a-century event was a permanent new reality.
And this just brilliantly illustrates the disconnect. At its peak, the narrative allowed Peloton to be valued like a hot tech company at around 20 times its annual sales. But the physics of its business, selling big, heavy hardware, meant it probably should have been valued like a normal fitness company at just 1 to 2 times sales. You could feel gravity just waiting to kick in.
So as if slowing demand wasn't bad enough, another crisis hit. A tragic accident involving their premium treadmill, the Tread Plus, exposed a deadly design flaw. The company's first response was really defensive, and that led to a huge public backlash. They were forced into a full recall, which not only cost them $100 million, but way more importantly, it just shattered the trust in their premium safety-first brand.
So, with the story broken and trust completely damaged, the stage was set for a fast and absolutely brutal collapse. The great unwinding was officially on.
Hey, remember that decision to massively ramp up production? Well, this was the result. A catastrophic inventory crisis. They had warehouses literally overflowing with bikes and treadmills that nobody wanted. It got so bad that in January 2022, a memo leaked revealing they were halting all production because they simply couldn't sell what they had already built. The financial bleeding was just immense. For the 2022 fiscal year, Peloton posted a net loss of $2.8 billion. To put that into perspective for you, that loss in a single year was equal to 35% of what the entire company was worth at its IPO.
The fallout was swift and severe. The founder and CEO, John Foley, stepped down, the company slashed 2,800 jobs, that's a fifth of their entire workforce, and that brand new factory in Ohio they'd spent hundreds of millions on, yeah, that was sold off for pennies on the dollar. The company was in full-blown crisis mode.
Okay, so Peloton's story is so much more than just a business failure. It's really a masterclass in timeless investment lessons that are crucial for anyone who's watching the markets.
And here is one of the biggest lessons of all. Watch what management does, not just what they say. While CEO John Foley was out there publicly telling investors that Peloton was just in the early innings of its growth, he was privately selling over $100 million of his own stock right near the peak. I mean, if the insiders don't believe in the story enough to hold on, why should you?
So what are the key takeaways from this whole mess? First, you have to be able to tell the difference between a temporary, event-driven boom and a real, permanent trend. Second, you have to understand that while a powerful story can make a stock fly for a while, financial gravity always wins. Third, valuation always matters. And finally, maybe the biggest lesson of all, a great product does not automatically make a great stock.
And in the end, this is what that financial gravity looks like. A share price hovering around $4, and a staggering $48 billion in total wealth just vaporized. The magic was gone. Peloton simply reverted to the mean, becoming just another fitness company.
So this leaves us with a really critical question to think about. In the heat of the moment, when a story seems absolutely perfect and the momentum feels like it'll never stop, how do you train yourself to spot the difference between a fleeting narrative and a durable, long-term reality? We try to unlock the truth behind these market stories so you don't get caught in the next narrative bubble. If you want more breakdowns of the data and the decisions that really move the financial world, make sure you subscribe to our next explainer. We're just getting started.